Have you seen that the Consumer Price Index for December is being released soon?
Oh yeah?
It should be in the next 3 days. Surely this will mean a large movement in the market that we could take advantage of.
You're absolutely right. If the CPI result is better than expected, the Federal Reserve's policies could become more dovish and asset prices could go up. If the result is worse, then the Fed needs to continue to battle inflation using higher interest rates, which could cause crypto and equity asset prices to go down.
So what we need is a trading strategy that takes advantage of this big shift that's coming regardless of the direction.
There are a few strategies that take advantage of increasing market volatility. Straddle and strangle strategies are two common ones, where you purchase a call and a put at the same expiration. For straddles, you can buy a call and a put at exactly the same strike price that both expire at the same time. If you look at this payoff diagram, any movement out of the range makes unlimited upside.
This is great. Let's use this now before the data comes out.
Then let's set this trade up. $1,310 for Ethereum. You can start off by swapping over the straddle template from the presets.
I'll set the expiry for January 20th to give the markets enough time to move after the data drops. We'll keep the strike price close to at the money of $1,300. And I feel like I could afford about 25 units at $90 each, which gives me a decent potential profit when anticipating the future market movements. The findings have shown our expectations are in line with the data. As such, the markets have concluded inflation is easing in the right direction. I've decided to close my position before anything dips too much more.
And what's your profit looking like if you do?
Great! I'm able to cash out for $254 per unit. That means for 25 units, I've got a payout of $6,350, more than doubling my initial premium within a week, which is a return of 182%.
That's amazing news! You can see how straddles are great for these large movements. The other strategy, strangle, uses two separate out-of-the-money strike prices per option. Since out-of-the-money strike prices need even bigger volatile shifts to become in the money, they're usually cheaper to buy, which means that strangles are generally cheaper to set up than straddles, but you require bigger price movements to be profitable.
But regardless of which one we used, if our prediction was wrong about the CPI data, the max loss would have been the total premium payout. Or we could have sold our position early once we saw no significant movement after the news and recouped some premium back. Essentially, we're just long on volatility without betting on a direction.